We got this surprise weakness in investment banking revenue in the latest quarter from JPMorgan. And just looking, there's a surprise decline in debt underwriting fees, for example. Let's get more on these results from the biggest U.S. lender. We're joined by Stephen Biggar, Director of Financial Services Research at Argus Research. Stephen, thanks very much indeed. JPMorgan stock in early trading, pretty flat. Anything jump out for you with these numbers?
Well, good morning, Andy. Yeah, like you said, the investment banking results were a bit weaker than expected. There's been this multi-quarter narrative about how constructive the capital markets environment has been. So this could have been some timing. You have to close deals in the quarter in order to book those revenues, and some of that could get extended into 2026. We're still looking for this extended upturn, and the constructive commentary they did mention on the conference call this morning. The backlog is growing. You think you've got lower interest rates, you've got improving CEO confidence and boardroom confidence. You've got this pent-up backlog after kind of a weak 3-year period. You've got more relaxed regulatory framework, and all that really bodes well for the both the IPO and the M&A activity for banks with large capital markets operations.
JPMorgan, though, rolling up its sleeves for a fight, it seems, over any attempt to cap interest rates on credit cards. The CFO saying we'd have to significantly change our card businesses and that everything is on the table in pushing back.
Well, it sure is. Yeah, I think we'll see a very strong response by the industry here, as well as the industry advocates in this space. It's very difficult to when you kind of mess with this with a bank's ability to price risk and only just kind of this one part of the equation, the interest rate. Bad things tend to happen. Whether it's the removal of credit availability, which is very much a disservice to consumers. You put extra risk in the system from not being able to cover credit losses adequately. We saw this in the financial crisis, where in the case of home lending in that era, where you make loans too easy to get and fuel speculation. You get bubbles and then a collapse in the very asset you're trying to help. So it's important to be careful here, I think, and take some time. And I don't think that is kind of inherent in the president's 10-day implementation period here. It's guardrails are very important, but it can be over-regulation can be just as detrimental as under-regulation or poor regulation.
It's interesting, the stock up more than 30% in the past year. According to Bloomberg, though, there are 19 buys among analysts, but 12 holds and 3 sells. So it sounds like Wall Street not convinced that there's going to be big gains in the near term anyway for the shares.
Well, as much as the narrative on profit growth, I think, is intact. If you ask all or most of those analysts, they would say, look, it's going to likely be a good year for profits for JPMorgan. So the question is about valuation. Has that 30% gain we've seen, is that kind of take into account the expectation of continued improvement in 2026? And I would say this is kind of a unique time for banks, particularly the large and the global banks, where this is a bit of a re-rating is going on. Not only do they have this long runway, we think, of improvement in capital markets, and that is a big wild card in terms of revenues and profits for banks. So that extended upturn could lead to valuation improvement. We also have this kind of generational change in regulatory, right? Ever since the financial crisis, it's been nothing but more and greater regulation, more compliance costs, and all this to satisfy regulators. And we think we're in a period now where that is at a minimum going to stay steady and maybe even more likely soften a bit in terms of capital requirements. So that helps free up capital for lending and other uses, for buybacks, for dividends, and so forth. So I think we're going to have, if you think about the banking industry and kind of how it's evolved And these stocks are not terribly expensive either, kind of 13 to 15 times are the 26 consensus estimates. So I think there is some more room. I don't expect 30% gains out of these large bank stocks, but and they have outperformed the market the last 2 years running. So this will be a third year. That's a little difficult, but again, I think the momentum is behind the profit story, and the re-rating does help those multiples.
I suppose one thing that could inflate their earnings would be a whole pile of initial public offerings and takeovers in the tech space fueled by AI.
Well, definitely. Certainly if you think about M&A and global announced M&A deal value is up 40% in 2025. So again, a lot of pent-up demand there. It's this boardroom confidence, the competitive pressures to cut costs, the more favorable regulatory environment I mentioned. All of that can add to deal demand. And there's been a lot of these mega deals, especially, definitely in vogue now with. You think about scale across technology or the financial sector, industrials. Falling interest rates obviously is helping on the financing front. We've got banks that are willing and able to lend. We've got a market that's willing and able to accept new equity, new debt issuance. We had 95 billion of investment grade debt issuance in the first week of January. So that's the highest level since the pandemic. Credit spreads are around 15-year lows. So that's very good for debt issuance, and so the market is I think is waiting for that, and is helpful in terms of getting financing, making financing available. So all of that is really helping the M&A environment.
The market's expecting some more cuts from the Fed, maybe not this month, but some more interest rate reductions. Generally, when rates are coming down like that, is it a good time to buy bank stocks?
Well, it can be. Rates are, we talk about rates being, banks rather being asset or liability sensitive, whether they kind of benefit from rising rates or benefit from falling rates. But when rates are too high, you might think, oh, that's great for net interest margins, but banks will always make money off the spread of that, right? So if rates go up, they're raising their deposit costs and they're raising their rates on loans. So at this point, really what we've seen for the last year now is that rates were too high, and that was crimping loan demand. So the fact that as rates do come down here, it is helping to restore some of that loan growth. So that just the growth itself is beneficial for banks, number one. Number two, the other dynamic at play generally is with net interest margins, and a steeper yield curve is definitely beneficial. So we've seen the low rates come down. That's what the Fed controls, and but the long rates, out of the 10 or the 30 year, kind of staying a bit stable. They did come down around mid-year, but relatively stable. So we've got that steeper yield curve, and that's beneficial for margins. So all of this is beneficial right now, at least for the lending business. But absolute falling or rising rates are not necessarily good or bad for banks. It's kind of where you are in the cycle. And again, those margins, how are they rising or expanding or contracting?
Stephen, thank you very much indeed.
Thank you.
Stephen Biggar, Director of Financial Services Research at Argus Research.